predicting currency movements in the Forex market, it feels less like science and more like trying to guess which way a huge flock of birds will suddenly turn. It's just this chaotic, massive, constantly shifting landscape.
Oh, absolutely. It's a beast. You've got global news,
Hmm.
economic data, sentiment, central banks. It's all happening at once.
Exactly. Simple cause and effect, often just lost in the noise. But what if you had, say, a classic tool, a statistical workhorse from way back that tries to find some order just by looking at the price's own history?
Could that even work in Forex?
Yeah.
That's the fascinating question we're digging into today, based specifically on this set of sources you share.
Great. Welcome. So our mission today is to really unpack the autoregressive integrated moving average ARIMA model. We're going to look at its statistical core, understand why it's been such a benchmark, but maybe more importantly, explore the big challenges it faces when you try and apply it to the wild world of currency trading.
Yeah, we'll look at the kind of data you need, how you should really test its performance, what the results usually show, and crucially, how people are trying to push past its limits.
Making it more relevant today.
Exactly. It's a deep dive into a foundational tool kind of meeting market reality.
And it all goes back, these sources point to George Box and Glom Jenkins in the 1970s, right? Their method really became a standard.
Absolutely. Box Jenkins, yeah.
Yeah.
It laid the groundwork for using models like ARIMA for analyzing, well, data that changes over time series.
Okay, so let's get into the core idea then. What is ARIMA actually doing when it looks at, say, a currency price chart?
Okay, so at its heart, ARIMA is what we call univariate. It's focusing on just one thing, like the historical price of your USD. Uses the past values of that price
Okay.
and the past errors it made in its own forecasts
Yeah.
to predict the next value. It's purely statistical pattern finding. It's not built on economic theory initially.
Right. So it's basically looking in the rearview mirror and saying, okay, based on the last few steps this price took and how wrong I was last time I guessed, where should it probably go next?
That's a pretty good way to put it, yeah. And the name, ARIMA, actually tells you the three key bits, A, R, I, and MA. Each has a number, a parameter.
AR is autoregression.
Correct. Autoregression. That means it relates the current price to its own past prices, its history, or lags. The PIA parameter in ARIMA, PSB and EDQ, just tells you how many past prices the model looks at.
So AR1 looks at yesterday's price, AR2 looks at the last 2 days, something like that.
Exactly. It sees a pattern like it often follows what it did just before. Then you have the I.
Integrated.
Right, IR for integrated. And this is, well, it's really crucial, especially for financial data like Forex, because most real-world price series, they aren't stationary.
Meaning their stats change over time, like the average price drifts or the volatility changes?
Precisely. The average price, the variance,
Mm-hmm.
it's not constant. And that makes finding stable patterns really difficult for a statistical model.
Okay, so integrated somehow fixes that.
It addresses it. It means we perform differencing. Basically, we take the difference between today's price and yesterday's price, or maybe even the difference of those differences.
So instead of modeling the price level, you model the change in price.
You got it. You do this until the resulting series does look stationary to stable, stable variance. The datum parameter tells you how many times you had to difference it. It's essential because ARIMA assumes stationarity.
Right, that assumption keeps coming up. Okay, so AR, past values, I differencing for stationarity. What about MA?
MA is for moving average. Now, this bit is interesting. It looks at the model's past forecast errors.
Its mistakes.
Yeah, kind of learning from its mistakes. The Q parameter tells you how many past errors get factored into the next prediction. It helps the model adjust after, say, a sudden shock that threw off the last forecast.
Okay, so ARIMA combines past values, D differencing steps, and Q past errors. That's the structure.
That's the foundation. But, and this is a big but for Forex, we have to talk about the assumptions baked in.
You mentioned stationarity is critical.
Absolutely fundamental. The data you feed it after differencing must have that constant mean, constant variance, constant autocorrelation. If it doesn't, your results, your forecasts, they're just not reliable.
And the other big one the sources mention is linearity.
Yes, and this is probably the biggest hurdle for Forex. ARIMA assumes the relationship between all those past values and errors, and the future value is linear.
Like a straight line relationship.
Exactly. But Forex markets, they are famously nonlinear, complex. They jump around, driven by news, panic, sudden shifts in sentiment.
Things that aren't simple, straight line extensions of the past.
Precisely. So that core linearity assumption is often a really poor fit for how currency markets actually behave.
So, okay, we've got this linear statistical model looking only at past prices and errors of one currency pair, trying to predict a market that's driven by, well, everything and behaves non-linearly. How does that compare to other ways people try to forecast currencies?
Well, it's a very different philosophy. ARIMA is statistical, pattern-based, usually focused on the short term. Contrast that with, say, economic models like purchasing power parity, PPP.
Like comparing inflation rates.
Right, or interest rate parity, IRP, or maybe behavioral equilibrium exchange rate, BEER models. Those are built on macroeconomic theory.
They try to explain why currencies should move based on fundamentals.
Exactly. They focus on the long-term drivers, inflation, interest rates, economic balance. They're trying to find some kind of fundamental equilibrium value. ARIMA originally just looks at the statistical properties of how the price moved historically, ignoring all that why.
Because it's univariate, only looking at the price itself.
Right. It only sees the price series.
Yeah.
But we know Forex is hammered by all these exogenous factors, external things outside the price history.
Which seems like a massive blind spot. Is there a way to, add that information in?
There is. That's where you get the Arimax variation. The X stands for exogenous regressors.
Ah, so you can add other data series into the ARIMA model.
Yes, exactly. You can include things like interest rate differentials, inflation data, GDP growth figures, trade balances, even sentiment scores from news analysis.
So trying to give the model some economic context.
Precisely. The sources mentioned a specific study where adding just 4 macro variables to an ARIMA model for USD or forecasting significantly improved its accuracy compared to the basic ARIMA alone.
That makes intuitive sense. I mean, a model that knows, say, the Fed just hiked rates should do better than one just looking at the chart wiggles.
It's an attempt to bridge that gap, yeah. Combining the statistical patterns with some understanding of the fundamental drivers.
Okay, so if you want to actually try this, build in an ARIMA or ARIMAX model. Where do you get the data, and what do you have to do to it first?
Data first. For the currency rates themselves, you can go to official sources like central banks. The U.S. Fed, for example, has daily data going back quite a way to 1990.
And for really deep history or more pairs?
Commercial providers are often used. Bloomberg, Refinitiv, which used to be Reuters. Refinitiv is noted in the sources for having data back to the 1950s sometimes, covering thousands of currency pairs.
Wow. And for ARIMAX, you need all that extra stuff, too, the macro data, maybe sentiment?
Correct. You need reliable time series for interest rates, inflation, GDP, whatever factors you think are relevant. The sources definitely stress that getting this broader data set is pretty key for building more robust models.
Okay, you've gathered all this data. What's the very first thing you need to do before even thinking about model parameters?
Preprocessing. The sources call it the unsung hero, and for ARIMA, it's absolutely critical. Cannot skip this.
Why so vital here compared to maybe other models?
Because of that stationarity requirement, mainly. But you start simple. Visual inspection. Just plot the data, look for obvious trends, seasonality, weird spikes or outliers, gaps.
And then you have to clean all that up.
You do. Missing data needs handling. Maybe you fill it forward or use interpolation. Outliers are tricky. Could be bad data, could be a real market shock. You need to decide how to treat them because they can really mess up the model.
And then stationarity again.
The big one for ARIMA. If your raw data or your macro data isn't stationary and currency prices usually aren't for yen, you have to difference it. Take the change from one period to the next.
And you check if the difference series is stationary. How?
Statistically. A common tool is the augmented Dickey-Fuller test, the ADF test. It basically tests the hypothesis that your data is non-stationary.
Yeah.
You want to difference it enough times so the ADF test lets you reject that hypothesis.
So you get a low p-value, suggesting it's likely stationary now.
Exactly. But the sources warn, don't over-difference. You can actually remove useful information if you difference too many times. It's a balance.
Are there other common pre-processing steps?
Yeah, sometimes taking the logarithm of the price can help stabilize the variance, especially if volatility tends to increase as the price level rises. Scaling might be needed depending on your software, but maybe less critical than for some ML models.
Okay, that sounds like a lot of careful prep work before you even get to fitting the model. Once the data is clean and stationary, how do you actually test if your ARIMA model is any good at forecasting?
You set up a backtest. The simplest way is you split your historical data. Use the older part for training the model and the newer part for testing it. You see how well it predicts the data it hasn't seen.
But you have to keep the time order, right? No shuffling.
Absolutely crucial. Time order must be maintained. But for time series, the sources strongly recommend something better than a simple train test split. It's called a rolling forecast, or sometimes walk-forward validation.
Rolling forecast, what
Wow.
does that involve?
Okay, instead of one split, you train on an initial chunk of data, say the first 2 years. You make a forecast for the next day or week. Then you roll the window forward. Add that actual day week to your training data. Retrain the model on this slightly updated history and predict the next day week. You keep doing this step by step through your test period.
So the model is constantly being updated with the latest data as you move forward in time.
Exactly. It simulates how you'd likely use the model in practice. You get new data, you update your model. A simple fixed split only tests performance based on one historical snapshot. The rolling forecast gives a much more realistic assessment of how the model adapts and performs across different market conditions over time.
That makes a lot more sense for dynamic markets.
Mm-hmm.
Okay, so you run this rolling forecast, you get a series of predictions. How do you measure how accurate they were?
Use standard error metrics, things like MAE, mean absolute error, just the average size of the errors, ignoring whether they were positive or negative. Then there's RMSE, root mean squared error. It squares the errors before averaging, so it penalizes larger errors more heavily, which can be good.
And MAPE?
Absolute percentage error. That one's often useful because it gives you the error as a percentage, like on average, the forecast was off by 0.5%. Easier to grasp sometimes.
So those measure the accuracy of the price forecast itself. What about AIC and BIC that the sources mentioned?
Right. A key information criterion and Bayesian information criterion. Those are used during the model building phase before the backtest. They help you choose the best PDQ parameters.
How?
They try to balance how well the model fits the training data against how complex the model is, how many parameters it has. Generally, you prefer the model with the lower AIC or BIC score. It's a way to avoid overfitting.
But they help pick the best P and Q, given a certain D?
Yes, that's a key point from the sources.
Yeah.
You can use AIC, BIC to compare models with the same level of differencing, the same D, but not to compare, say, an ARIMA with an ARIMA 1011 because the differencing changes the data being modeled. Got it. Okay, data prepped, rolling forecast run, metrics calculated. What do researchers typically find when they apply ARIMA to real Forex data? What do the results look like?
Well, visually, if you plot the actual prices against the ARIMA forecasts, you often see it tracks reasonably well during, say, smoother trending periods or times of low volatility. It can capture that sort of linear momentum.
But Forex isn't always smooth.
Far from it. And the plots usually show the model struggling when things get choppy or during sudden shocks or when a trend suddenly reverses. The forecast just tends to keep going in the old direction for a while. It lags reality.
So performance varies a lot depending on the market mood.
Big time. It might look okay in a clear, steady bull or bear run. Those have a stronger linear element. But in sideways, range-bound markets, it can get whipsawed.
And the real test.
Yeah.
High volatility, crises.
That's where it really tends to fall down. The sources point out that forecast errors can spike dramatically. One mentioned maybe 30% higher errors during crisis conditions compared to normal times.
Wow. That linearity assumption just completely breaks down when you get those huge, sudden, non-linear moves driven by fear or major news.
Yeah, that really highlights the limitations. It sounds like it's often best when the market is calmest, which is maybe when you need a complex forecast, at least.
There's some truth to that, yeah. And it ties directly into one of its biggest weaknesses, predicting turning points.
The holy grail, catching the reversal.
Exactly. Because ARIM is basically extrapolating past linear patterns, it's generally pretty poor at anticipating those major trend changes or sudden market shocks. A big surprise event can, theoretically, have an infinite impact in the model because it has no mechanism to understand why the market just lurched. It just sees a massive error.
So the linearity trap, the struggle with volatility and turning points, needing that perfectly clean, stationary data, it really does sound like standalone ARIMA is, well, facing a tough challenge in Forex.
As a standalone tool for forecasting in such a dynamic market, yes, it has very significant limitations, especially if you're trying to forecast more than just a few steps ahead. Its predictive power tends to decay quite quickly.
Okay, but despite these statistical flaws, people do try to use these forecasts for trading, right? How do you actually go from ARIMA predicts price will go up to putting on a trade?
You can, yeah. The forecast direction itself can be a basic signal, predicts up, maybe a buy signal, predicts down, maybe a sell signal.
But that's just the entry. A forecast alone isn't a full strategy. You need risk management, right? Stop loss, take profit?
Absolutely critical. Non-negotiable, really, because the forecast will be wrong sometimes, often significantly in Forex. Common ways to set stop-loss SL and take profit TP levels include using technical analysis support and resistance zones,
Okay.
or using fixed risk-reward ratios, like aiming to make twice what you're risking, or using volatility measures like the average true range, ATR, to set stops that widen out when the market gets choppy.
That ATR approach makes sense, giving trades more room in volatile times. Is there a way to use the model's own output more directly for risk?
Yes, and this is a more sophisticated idea highlighted in the sources, using ARIMA's prediction intervals.
Prediction intervals, what are those?
So the model doesn't just spit out one single number as its forecast. It can also calculate a range, say a 95% confidence interval within which the actual price is likely to fall according to the model.
And that range gets wider if the model is less certain.
Exactly. If the historical data was messy or the model fit wasn't great, that prediction interval will be wider, reflecting higher uncertainty in the forecast.
Okay. So how do you use that for stops and targets?
You can dynamically set your stop loss and take profit levels based on the boundaries of that interval. If the model produces a wide interval for the next period, high uncertainty, you might automatically set your stop further away. If it's a narrow interval, more confident, maybe a tighter stop.
Huh. So you're directly linking the model's own assessment of its uncertainty to your risk management.
Precisely. It's quite elegant, really. The model isn't just giving a prediction, it's telling you how confident it is, and you use that confidence level to manage your risk on the trade.
That feels much smarter than just a fixed stop. Now, when you simulate this whole process, forecast, signal, risk management, what's the bottom line? Does it actually make money?
That's the ultimate test. You look at simulated trading results, not just statistical accuracy like MAE or RMSE, but things like net profit or loss over the backtest period. And crucially, risk-adjusted return, often measured by the Sharpe ratio.
Sharpe ratio higher means better return for the risk taken.
Right, and you also look hard at maximum drawdown. That's the biggest drop in your simulated account equity from a peak. It tells you how painful the losing streaks might be, how resilient the strategy is. Lower drawdown is better.
And what do these trading simulations typically show for standalone ARIMA strategies in Forex?
The sources generally suggest that. Well, while they might achieve decent forecast accuracy metrics during stable periods, standalone ARIMA models often don't show compelling risk-adjusted profitability or impressively low drawdowns compared to other, more complex approaches.
So good scores on paper don't always mean good trading results.
Exactly. Statistical accuracy doesn't automatically translate into a robust, profitable strategy, especially once you factor in real-world things like trading costs, slippage, and the model's vulnerability during volatile times.
Okay, so given these limitations, how are people trying to improve ARIMA or maybe integrate it differently to make it more useful in practice for Forex?
Well, one key area is just getting the basic ARIMA part right. Careful parameter tuning, finding the best PDQ values. This involves a bit of art and science.
Art and science.
The art is often looking at diagnostic plots like the autocorrelation function, ACF, and partial autocorrelation function, PACF, of your stationary data. These plots can give you clues about potential P and Q values.
And the science.
That's using automated methods, like grid search, just trying out many combinations of PDQ and seeing which one performs best on some criterion. Or using functions like ARIMA found in some statistical packages, which algorithmically search for the parameters that minimize AIC or BIC.
And you mentioned checking the residuals earlier. That's part of tuning.
Absolutely critical diagnostic step. Once you've fitted a candidate model, you look closely at the errors it made on the training data, the residuals. They should look like random white noise, no patterns left.
If there are patterns left in the errors,
it means your model hasn't captured all the predictable structure in the data. You need to rethink your parameters, PDQ, or maybe even the model type.
Okay, so better tuning helps. But it sounds like the bigger gains probably come from getting more information into the model, moving beyond just the price history.
Definitely. We talked about Airmax using macro data like interest rates or inflation, but people are integrating even more diverse data sources now.
Yes.
Sentiment analysis is a big one. Using machine learning techniques to analyze news articles, social media posts, financial commentary, trying to quantify market mood.
And maybe order flow data, seeing actual buy and sell pressure.
Yes, if you can get access to it. Looking at the flow of orders can give you a more direct read on market dynamics. For related digital assets, the sources even touch on using on-chain data from public ledgers. The whole idea is to give the model more context.
And the most promising direction overall seems to be these hybrid models.
That's what the evidence strongly points towards, yes. Combining ARIMA's strengths, modeling those linear time-dependent patterns with models that are specifically designed to handle nonlinearity and volatility.
Like what kind of models?
Things like artificial neural networks, ANNs, or more sophisticated recurrent neural networks like LSTMs, long short-term memory networks, or combining ARIMA with volatility models like RCH.
So you let ARIMA handle the straightforward linear part of the price movement.
Exactly. Let it capture that baseline autoregressive and moving average structure.
And then you use the machine learning model or the JRCH model to capture the complex stuff, the nonlinear dynamics, the volatility bursts, the sudden jumps.
Precisely. The hybrid approach aims to get the best of both worlds. The ARMA part provides a solid linear foundation, and the nonlinear component, like an ANN or LSTM, models the complex patterns and deviations that ARIMA misses. The JRCH component specifically models the changing volatility.
And do these hybrids actually perform better?
The studies referenced in the sources consistently show that, yes, hybrid models like ARIMA-N, ARIMA-LSTM, or ARIMA-GARCH tend to achieve significantly better forecast accuracy, lower RMSE, MAE, maybe, compared to using ARIMA alone. They just provide a more complete picture by tackling that core linearity limitation head-on.
That makes a very compelling case for not relying just on ARIMA. Okay, let's try and wrap this deep dive up. What are the absolute essential takeaways about using ARIMA in Forex based on everything we've discussed from these sources?
Okay, first, ARIMA is a classic important statistical time series model. Its roots are in the Box-Jenkins methodology. Its strength is in modeling linear time dependencies and its relative interpretability. It can be useful, especially for short-term forecasts when markets are behaving, well, relatively predictably.
But applying it effectively to Forex needs serious, careful work. Rigorous data preprocessing is non-negotiable, especially getting that data stationary via differencing. And you need robust testing, like the walk-forward or rolling forecast method, to get a true sense of its performance.
And critically, you have to understand its inherent limitations for a market like Forex. That core linearity assumption is a major weakness. It makes ARIMA struggle badly with high volatility, with sudden shocks, and especially with predicting major market turning points. Its performance can degrade significantly precisely when you might need a good forecast the most.
Right, so the overall message from the sources seems to be, ARIMA can be a useful building block, a good baseline model perhaps, but it's rarely going to be the complete answer on its own for trading Forex successfully.
Exactly. The consensus really points towards using ARIMA in Forex most effectively when it's side. 1. Integrated with other relevant data like macroeconomics or sentiment, perhaps using an ARIMAX structure. Or 2, and likely more powerfully used as one component within a hybrid model.
Combining it with nonlinear machine learning models like LSTMs or ANNs, or volatility models like GARCH to capture the full complexity of market movements.
Precisely. Those hybrids seem to offer the best route to overcoming ARIMA's linearity constraints. And alongside all that, you need careful parameter tuning, constant checking of model diagnostics like residuals.
And maybe most importantly, very robust risk management. Perhaps even leveraging the model's own uncertainty via those prediction intervals we talked about.
Which actually leads nicely into a final thought for you to chew on.
All right, here's something to ponder then. Given that even these really sophisticated hybrid models, combining ARIMA with advanced AI, still struggle to consistently nail major market shocks or predict exact turning points, does true mastery in financial markets maybe lie less in chasing that perfect point forecast and more in getting really good at understanding, measuring, and actively managing the inherent uncertainty and risk? Using tools like prediction intervals, focusing on things like drawdown control and portfolio resilience rather than just forecast accuracy alone.